Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. And of course, we are going to be talking about US CPI today. Could we even talk about anything else? It is needless to say the biggest piece of US event risk on the calendar this week. And the question, as we've been asking really for the past several weeks, is this good or bad that CPI might go up or down? Are the markets going to like a higher number or a lower number? Is the calculus that we've been using to figure that part of it out as traders, is that still holding? Is that still valid? Or has there been a transition? And so herein, let's get a grounding in where the numbers are, how it all looks, and then look at the price action response. Because, of course, at the end of the day, we care about how to trade around what this might do, or at least in markets that this might impact, rather than have an academic exercise of sorts. So let's look first at the expectations. We're looking for headline inflation to register unchanged at 5%. That's according to a survey of economists done by Bloomberg. We're looking for core CPI to come in just a touch from 5.6 to 5.5%. The month-on-month core number steady, the month-on-month headline number a touch higher. And let's see where that comes from. Really, the most instructive aspect of this is to look at the breakdown in how this is constructed, where inflation is now coming from. And you can see here that the food component is fairly steady. The energy component is, at this point, a slight detractor on CPI. So the move lower in oil prices and the unraveling of demand, that has certainly been a major reason why you can see here headline CPI has closed the wedge with what you're seeing on the core number. The headline number is there in the solid red, and the core in the dotted line. I'm not sure where the label on that has gone here, but there it is. If we look at what's going on with where the bulk of inflation now lies, it appears to be in that lower part on the bottom of the chart. That dark area, services excluding food and energy. This is where it seems the bulk of inflation now sits. This is what is keeping us relatively elevated in the 4 to 5 range. And what we can see here is that we have a goods side of things, which has been squeezed to almost nothing. Very, very modest. You can see that here. This is a chart we've been looking at for quite some time now, of course. This is total global trade volume as relative to measures of U.S. inflation. You can see there is the expected number in the red line there for CPI, seen holding at 5. You can see here that we have the topping in the total global trade volume measure here, which is just exports plus imports, that data from the IMF, that we are topping right at the start of last year and right around the end of the first quarter. This, of course, is exactly lined up with where the Fed started its rate hike cycle in March. So you can see that from there, the impact of tightening is actively squeezing global growth, because what the Fed does in raising the cost of borrowing dollars is it increases the cost of borrowing what is the quintessential commercial medium of exchange, the US dollar. That is something that impacts not just the US, it impacts financing economic activity essentially everywhere, with very few exceptions. Countries like North Korea that are sitting outside of the global commercial system come to mind. Perhaps Russia increasingly with the recent sanctions. But for the most part, what the Fed does in raising US rates increases rates everywhere, even if those central banks don't actually do anything. A great case in point is Japan. So what you're seeing then is how that goods part of the inflation story is getting squeezed out. The Fed is slowing economic activity. That's cooling goods demand. At the same time that supply chains are increasingly being mended, there's an increasingly robust adjustment to what supply chains have evolved to in the wake of the U.S.-China trade war, which began now quite some time ago. If you wanted to mark the start around 2018, let's say, you could venture that we already are looking at something on the order of 5 years for supply chains to adjust. So it's not surprising that on the goods side of things, that in conjunction with what the Fed has done has meant that this goods component has been squeezed to a very small contribution. What's going on the service side, likewise, looks like it's heading in the right direction. This is the services component of the ISM survey that we just got last week in the dark blue line there. We also have here core CPI and PCE, which seem to lag this with about a 2 to 3 month lag, depending on which one you're looking at. If you're looking at CPI, it's about a 3 month lag. And that's just a difference in the statistical construction of those measures. If you look at where then this seems to be pointing, it's significant disinflation down the road. You can see that just as we head into the oncoming months, there is a precipitous disinflation that's being signaled in the ISM index here that's incoming. So ostensibly, this too will be worked down by a significant margin in the months to come, though now, of course, it is still an important part of this overall thing. That aspect finds its most intractable bit on the services side of things in the labor market. This, of course, is where it is most difficult to adjust for disinflation because wages are sticky. We have a situation where, for example, the pricing of some consumer service, like, let's say, cell phone access or internet access, those prices can be changed by their providers. When one becomes employed and signs a contract, that contract is not easily adjusted for. Typically, those contracts are, of course, not renegotiated more often than annually. And when they are negotiated annually, very rarely do they involve adjusting wages down for inflation. Typically, it's only up. And the way that you adjust one's labor costs as a firm for inflation is with layoffs, which is, of course, something that we've already seen happen in some industries that were particularly hurt by interest rate hikes. Tech sector, obviously, front of mind there. What you see then is that the Fed's job at squeezing the good side of things has arguably worked exactly as the Fed intended, and some of the transitory aspects on that side dissipated as the Fed expected. On the services side, you're on the right course here, it would seem. That's the part that's harder. And of that part that's harder, the hardest is labor, the cost of labor. And this, of course, is so much more important for services than it is elsewhere, because something like 3/4 of the U.S. economy is employed in the service sector. It is by far the dominant employer as relative to manufacturing or indeed agriculture. And so what you're looking at here is some initial sign that you're going in the right direction. You can see that the mismatch here between labor supply and labor demand is being worked down. And the latest NFP numbers showed us that it is at this point at the lowest since about September of 2021. So it is seemingly going in the right direction, but it isn't quite there yet. We can still see that labor supply is significantly short as relative to demand compared to where we were before COVID. This, of course, right here is COVID. This is the lockdowns creating tremendous amounts of supply and very little demand for labor amid the COVID-inspired recession and, of course, the lockdowns. This is something that's a little bit more normal. And you can see that there's been a bit of an undersupply as you get the retiring of baby boomers starting to really hit some kind of a meaningful cadence right around 2017, 2018. And as you then get here, you can see not only did that retirement of the baby boomers accelerate through the lockdowns, but of course, the mismatches are now much more dramatic. Getting back to inflation of 2% would mean working this down to something that looks more like that. And so with that in mind, we see that it does appear to be moving in the right direction. And perhaps most importantly, the market believes it will work. Because if you look at where the 2-year break-even rate is, which is, of course, the bond market's measure of expected inflation, you can see that it's at 2.1%, but just barely so, right on the line between 2 and 2.1. The 2-year break-even for the less than initiated here is the bond market's expected inflation number as priced into the market directly. If you take the difference between nominal yields and real yields, which are inflation adjusted, you end up with that inflation adjustment as residual. And that's what we're looking at here. So the bond market is saying in 2 years' time, within the Fed's outlook window and generally on the timeline that it wants, we are going to get from choose your adventure as far as favored PCI or a CPI or PCE inflation measure, you're going to successfully squeeze out between about 2.5 or 3% out of inflation and get to give or take 2.1 in 2 years. So the market is looking at the current setup and is saying what the Fed has already done has put us on track to get to where the Fed wants to go over this window. That essentially the amount of tightening the Fed has already done has already squeezed goods, as we've seen, to get us from the heady highs that we saw on inflation around 9%. Let's use CPI here, since that's what's coming out as our benchmark. So the goods side has indeed shed about 4%. Now getting from 5 to 2 and shedding another 3%, the market thinks there's enough pain there in the pipeline to get us there. There's enough of a squeeze on the economy. And you can see it in investors' policy expectations. There in the small dots is the yield curve as it stood before SVB, the implied policy curve. In the solid line is the current one. Hiding underneath it, you can just barely see it at the front here, is where the curve was a week ago. You can see that's right there. This is about the only meaningful change that we've seen in this curve from right before the Fed policy announcement. That, of course, was on the 3rd. This curve is from the 2nd, which is exactly 1 week back from today, which I thought was instructive. It shows you how little the Fed policy announcement has actually done. It's only moved the actual policy rate. Here's the rate hike. We've gone from here to here, from 475 to 5, essentially. Everything else about this curve is essentially unchanged. These curves are right on top of each other. So the market is looking at this and is saying, there's nothing about this CPI number, assuming, of course, that it doesn't do something terribly out of consensus, that is going to change the Fed outlook baseline. That this is not, at this point, something that is going to move that needle. Now, this then raises a really important question. Does that mean this CPI number doesn't matter? Well, the argument would be, well, not necessarily. Because if we consider where we are currently, we've been in a range on bonds for quite some time. That makes sense. Policy expectations are stable. We've been in a range on, let's say, the 2-year since the end of March, the beginning of April. Same thing with the 10-year. Same thing with the long end of the curve. We have seen relative standstill in the dollar since about mid-April, give or take, looking at benchmark euro rates, but certainly not dissimilar from things we've seen elsewhere. We've seen gold relatively idle in recent weeks. We've seen stocks idle in recent weeks. So what we're looking at here then is a market that says we will be at 2%, assuming the stasis that we're looking at right now. How likely is that stasis? Well, perhaps not so likely. Things don't generally sit unchanged for 2 years at a clip when you have still an uncertain amount of further tightening working its way into the pipeline, and at the same time, a fiscal situation that might give you some tightening on that side of the equation. We, of course, are talking about the debate about raising the U.S. federal debt ceiling, whereby if you were to have the best of times and there were some kind of a deal ultimately, it would probably mean that one side has to give up some spending, the other side has to give up some tax raises to the other. So from the left, you might have to spend less. From the right, you might have to countenance some tax hikes. That combination is both together and in its parts fiscal tightening on top of monetary tightening that's already underway, and that still, again, looking at these break-evens, has a tail significant enough still to be absorbed that we're going to get, ostensibly, from 5% to 2% CPI over a 2-year period. So markets are kind of in a holding pattern here, but the likelihood that nothing at all occurs to keep them there seems relatively low. And the sum of concerns seems relatively high and relatively skewed on the anti-growth risk aversion side of things. Consider what that looks like in the Fed policy outlook. We have stasis in rates in June being baked in. That stasis seems to continue in July. By the time we get to September, we're looking at maybe the possibility of a cut. About 19 basis points, almost 20 basis points of one are already priced in. By the time we get to November, that cut has occurred. And we're looking at just shy of 50 basis points in cuts. So we have that cut being significantly priced in, if not all the way. It's almost 50. By the time we get to December, that 50 is there, and we're flirting with 75. 65 of that 75 already priced in. By the time we get to January, we've cut rates 3 times from the current setting. So through the remainder of this year, we have between 50 and 75 basis points in cuts. And between now and the end of January, we have those 75 basis points. We have those 3 cuts and a slight possibility of maybe a little bit more. So there's a bit of a difference in sequencing here, December to January, where you get the 75 basis points fully realized. But the market is clearly looking at this and saying, in order for this to remain on an even keel, these cuts have to occur, or maybe more cuts could be a surprise, or maybe less cuts could be a surprise. And that's really the matrix of options. Now, considering that we have all of this stuff in the pipeline still, as the market seems to be signaling, more tightening yet to be absorbed, and on the fiscal side, there is a risk that you might have more fiscal retrenchment in the best of cases. If there's not a deal and spending actually has to be paused while there is one, and markets need to be shaken more significantly because we can't get consensus, well, then the fiscal retrenchment might be much more significant. But even in the best of cases, there seems likely to be some. So if the CPI number were to surprise on the upside, the likelihood that the market is as reactive as an equivalent surprise on the downside seems difficult to make. The Fed has signaled they're on pause. They would probably have to get a really meaningful upside surprise to change course. So really the number would need to be high enough for the markets to shave away some of these cuts that they've put into the outlook. It might very well be, though, that if you get a soft number, the bar to volatility is lower. Because the Fed keeps saying they're not going to cut rates. And the market clearly doesn't believe them because they've priced in 3 cuts, give or take, for the back half of this year plus January. If the market is wrong, and some of these cuts go away, that's generally in line with where the Fed is, and they don't have to change their talking points or change their thinking. It will, of course, impact the price action across markets, but it seems like it would have to be a really significant topside surprise. And all of the leading numbers on inflation that we've just looked at, from the ISM to the global trade volumes, all of these things seem to suggest that the path toward disinflation continues in indicators that tend to lead CPI by 2-3 months. The risk then seems to be the other thing, much more so, that you get a softer number that undershoots by a significant margin. Only the response isn't that we should necessarily even have more cuts, or about that, and more about what that says about the state of the economy and recession risk. Consider that most recently, after the SVB, we'll say, themed banking crisis, since that was the first bank to really feel the pressure here, we've recovered to where we were on risk. You can see there in the yellow bars, that's the S&P. The dotted line is just a 5-day moving average to get a general sense of direction. It's recovered back to around the 4,200 level in the wake of the SVB shakeup in March. But now Fed rate hike odds and stocks are moving in tandem, and both are drifting broadly lower off their recent peaks. Nothing is actually broken down. Everything is kind of still in a bit of consolidation, but the highs are getting lower, and most importantly, they're getting lower in tandem. Whereas looking at February, what you saw was the red line going up, the yellow bars going down. Because the thought process still was, if you get better data and that pushes up Fed policy to a more hawkish setting, that's bad for risk. So these things were moving inversely. Whereas what you're seeing here is a very different kind of logic, suggesting that indeed it is recession that the market is acutely focused on. Not so much that more Fed rate hikes might hamper an otherwise robustly growing economy. There's further confirmation that this change has occurred in the dollar. You can see its relationship in the wake of the peak in Fed policy odds has changed as well. Before the SVB fiasco in March, you saw the dollar and Fed rate hike odds move in tandem. So when you had a more hawkish setting on policy expectations, the dollar gained. That is pointedly not what you see now, where when you have the overall direction lower, you can see this red arrow pointing down, the dollar is gaining. That's despite the fact that its own yield advantage is being eroded. And now, when Fed rate hike odds are a little bit in recovery, a little bit on an upswing in the wake of Friday's better positioned NFP report, which gave us some reasonably good data for the labor market, the dollar is lower. So economic data that has actually boosted yields is also weighing on USD. So this is indeed a risk-on, risk-off, recession sort of minded market. And against this backdrop, a soft CPI number wouldn't so much be seen as good news, because it would mean the Fed might have to see the market's outlook as something to adjust to rather than something to push back against. But more so because softer CPI would speak to ebbing demand, slowing growth, and disinflation by way of getting closer and perhaps already groping at recession. And if the number really misses, the response might then be lower stocks, stronger dollar, and everything that follows from it. Lower yields, higher gold, higher yen, higher bonds, lower Australian dollar, Canadian dollar, lower growth-geared commodities like crude oil, copper. And that's how we're setting up for this piece of data to cross the wires. And that has been Macro Money for today. Thank you very much for joining me. We're here Monday through Thursday after overtime, which is a recap of the day's market action that I do with Chris Vecchio, head of Futures and Forex here at tastylive. I'm back on with Chris on Fridays for Futures Power Hour. I am on with Tom and Tony on Sunday evenings for First Call. And outside of the shows, I'm opining on Twitter at Ilya Spivak. Thanks once again, everyone. See you tomorrow.